the Cooperative Credit Union League and the Arizona Credit Union League and affiliates. I want to welcome you and thank you for participating in this, our first webinar. This evening we will be talking about operational risk. I am Mary Lee Blummel, Member Services Consultant with the Arizona Credit Union League, and with me this evening is Mrs. Colleen Curtis, President, CEO of Southwest Healthcare Credit Union, located here in Phoenix. Colleen's credit union is $16 million in assets, so she is a small credit union, understands your needs. I wish to thank Mr. Ellis Southwell, President of the Antigua and Barbuda Cooperative Credit Union League, for arranging the facilities for this presentation. And I'd also like to thank Joshua Fetting, Program Specialist with the World Council of Credit Unions, for coordinating the webinar. This evening, Colleen will be talking about two key areas in operational risk: investments and lending. In the United States, it should be mentioned that credit unions are limited in the types of investments that can be purchased. The majority of our small credit unions, say those under $25 million in assets, limit themselves to primarily certificates of deposits in other credit unions or in banks. The amount in any one institution is normally limited to a maximum of $250,000, which is the current amount of insurance that is guaranteed against the loss of principal. So here in the U.S., we have insurance that protects against loss on investments should a financial institution fail. Now, this is something that you folks do not have. Another issue is in the lending area. Here in the U.S., we have credit reporting agencies that accept information on an individual from all of the creditors of that individual. Therefore, when a person comes into the credit union to apply for a loan, the credit union can make one call to the credit reporting agency and obtain a history of repayment for that member. This eliminates the need for the credit union to call each of the creditors directly to ascertain the repayment history for that member. So just a couple of differences that we have here in the U.S. as compared to your folks there in Antigua, Barbuda. With this background of some of the differences in the credit union, I have the great pleasure of turning the program over to Mrs. Colleen Curtis. Colleen has been the President, CEO of Southwest Healthcare Credit Union for 22 years and had 4 years credit union experience to that. And now, here is Colleen.
Thank you, Mary Lee. Welcome everybody to this. I hope that some of the information that we give you tonight will be fulfilling and interesting to you. The first thing that we'd like to talk about is how the different things of risk that we're going to talk. In the investment risk, we're going to talk about market risk, gauging risk, diversification, common investment strategies. And on lending risk, we're going to talk about the new loans that you have and you deal with on a daily basis, and the current loans and how we ascertain to keep them current and keep them sound. So on with that, we're going on to the investment risk. Investment guidelines, when managing the credit risk of investments, credit unions should be mindful to both diversity and establishing concentration limits on their investment holdings. Even when investing in the highest credit quality of investments, a credit union is potentially impacted by investment credit risk if they are properly diversified or hold too large a concentration in one issuer or obligor. What kind of credit risk exposure do you have and how is it controlled? Now is an excellent time to review your investment holdings, policies, and practices to determine if you are on top of your investment credit risk and upholding the diversification and concentration principles. Investment guidelines may include sound investment policies. Investment policies are really important to your credit union. The policy should say what you are allowed to invest in, and more importantly, for how long. We just had an audit just recently, and that was one of the things is how long are you going to invest in today's economy? Is it good to go past the 2 years? It is even good to go past the 1 year. Some people here are saying that you should only do 90 days because of things going up and down. So we have invested in some things longer than 2 years, and they're saying that maybe we shouldn't be doing that. Risk and return policies. The risk return of an investment is the relationship between the amount of return gained on an investment and the amount of risk undertaken in that investment. The more return sought, the more risk that must be taken. So if you're getting a high rate, there's probably some risk that goes with that. Investment objectives. What are you trying to achieve from the investment, and with what amount of risk? Again, the more return sought, the more that must be taken. Asset allocation. Asset allocation is the strategy used to distribute the credit union's investments among various classes, such as stocks and bonds. That is why you need to know what the financial institution that you're investing in, what they're investing in. Management and strategies. Together, your board and management should work together to decide the investment portfolio, what it should be. Some credit unions choose to have an investment committee, as we do, made up of both board members and management, so that it's not just one person investing that investment of your credit union. Now we're going to go on to market risk. Market risk is the fluctuation of investment prices due to the investment demand or lack of demand for investments in the market as a whole. Some market risk refer to the portion of an investment risk that is shared by all similar investments. Market risk affects all classes of investments. However, market risk may also affect investments individually. If a company is perceived as a good investment, the price will rise as an investor demands increases, even if the market is generally down. Due diligence on the financial institution. Review the financial statements of the institution that you're investing in. They might be at risk, so you need to check. High rate, why are they giving you a high rate? May have a problem. They might have a lack of liquidity due to high loan demand, but the question would be, what kind of loans are they making? Gauging the risk of investments. To evaluate the potential risk and return of a particular investment, many financial analysts look at the long-term history of the security. They calculate the security under the changing market conditions. The aim of these calculations is to create an efficient portfolio. An efficient portfolio demonstrates the largest expected given at a particular level of risk. An efficient portfolio also demonstrates the minimal level of risk for the return expected. A statistical analysis of the credit union's investments can help the credit union to review and revise the portfolio to match the credit union's priority and risk comfort level. Diversification. Diversification is when you add variety to a group. Your credit union may diversify by adding an entirely new product line, but simply creating a new version of an old product is not diversification. It does not mean some more of the same thing. In finance, diversification is investing in instruments that are backed by different kinds of investments. Diversification decreases risk by limiting the change that any one set of economic factors will have a major negative impact on the value of the portfolio. Sometimes people get caught in the trap of more is better. Diversification is not piling more eggs into your basket. The aim is to create a portfolio with steady overall growth, rather than one that is up one year and down the next. This will produce good returns with lower risk. Diversification can help you set and direct an investment path that meets your financial goals. One thing you need to do is ladder your maturities. You might need that money for a high loan demand. Smaller amounts in one institution. Instead of $100,000, change it to 2 certificates of $50,000. That way, if you need it, you're not losing the going into the penalty phase. Common investment strategies. Buy and hold. Buy and hold is a long-term strategy based on the view that in the long run financial markets give a good rate of return despite periods of change or decline. Dollar cost averaging strategy. There's dollar cost averaging is the practice of investing a fixed dollar amount at regular intervals, such as monthly in a particular investment or portfolio, regardless of its share price. In this way, more shares are purchased when prices are low, and few shares are bought when prices are high. Market timing strategy. Market timing is the concept that one can enter the market on the lows and sell on the highs. It does not work for small investors, so it is better to simply buy and hold. Review your cash flows need to be determined the length of investment. The more the risk, the more potential the return. Successfully managing the risk and return is the goal of most investors. Financial experts have developed a variety of measures to assess the risks of specific investments. Diversification is a means of varying the kinds of assets you invest in to maximize returns while minimizing risk. Depending on the credit union risk tolerance, you might want to choose to pursue a low-risk strategies as buy and hold or dollar cost averaging, or taking the higher risk of market timing strategies as you seek higher short-term returns from your investment. You, being in Antigua, can look for more help through the financial advisors at UNFCU. There's a website that you could go out to get more help from also in this advice, and that's www.unfcuadvisors.com. It is the United Nations Federal Credit Union, so they're there to help you if you haven't used them before. So now that we've talked about investment risk, we'll go on to lending risk, which we can talk about a lot today. Loan growth is possible even during economic nightmares that we are all sustaining to today. To strengthen lending opportunities, strategic planning is essential. Credit union executives must develop lending strategies for the future, even during the uncertainty of our environment. There are still opportunities to be found in real estate and auto lending, but there is always going to be a risk. So we're going to go into new loans risk. The important 5 C's of credit: character, honesty, and reliability. Character, in the early years of credit unions, character was the primary and sometimes the only security for granting a loan. So I was made aware today, you don't have the credit reporting that we do here. So you probably still use that security of character in doing your loans. Capacity, the ability to repay. Regardless of how good a person's character is, a loan should never be granted unless the member has the capacity to repay. It is a disservice to the member to allow him or her to increase debts to the point of possible financial ruin. Debt ratio is important. A debt ratio is to calculate and determine the ability to repay. So if you can do that ratio on them, that would be helpful for you. We, at our credit union, don't go over the 45% to debt ratio. Anybody that's over 55 is probably headed towards bankruptcy, and I don't even know if you have bankruptcy in your country. So capital is another C, and it is net worth, what is owned and what is owed. Capital, determining the applicant's net worth is not always necessary, but it's a good practice, especially in granting real estate loans. Collateral, security pledged, items used. What is the real market value of the item being pledged for the loan? Will it have sufficient convertible cash value to pay the balance if the loan is recovered? Will the item depreciate at a faster rate than the unpaid balance of the loan? Does the borrower have clear titles to the items? Are there any prior liens? Conditions. Conditions is the circumstance like the general economic situation. Conditions refer to the general economic situation during a recession or a period of tight money. A credit union may be unable to make the same type of size loans that are made during the better economic times. So now that those are the 5 lending risk C's, I'm just going to go over some highlights that we try to use in our loan risks. Due diligence is a very important factor regarding new loans on today's market. What are members' other obligations besides the one that they have at your institution? Look at the member's employment. That job may or may not be here in the future. Length of employment. Review the pay stub to see if the year-to-date matches what the member is stating for the length of employment. Does it take 2 incomes in the household to pay all obligations? If so, what if one of them loses their job? When reviewing the loan, is there collateral available to cover that loan? Is the unsecured loan limit too high for the member at the present time? You might need to lower that credit limit. Debt ratio is a must. Can this member afford this new obligation? Don't go outside the guidelines. If the current debt ratio is close to what the policy allows, what would happen if a member would lose their current income? They will not be able to meet their obligations, which would include your credit union. Members' assets. Review to see what kind of assets the member has. Do they own their property? Do they rent? Do they own their auto, or do they have savings? Another sign of character. Very important lesson. Know as much as possible about your borrowers. Some of you small credit unions are probably like us. You know everything about that member. So that helps. And the bigger credit unions don't always get to do that. So know as much as you can about the member before you give them that loan. The current loan risk. Current loan risk is, there's 3 L's to that, and that always is the front line, your tellers or your loan officers. If they can learn as much about that member as they can, look at the member, see how their accounts are looking, and listen to the member. See if they can give you any information. And we'll talk more about that. Delinquency. Work with a credit union. Not willing to work with a credit union, and redirect staff. So we're going to talk about current loan risk. Watch current loans carefully for problems that might have been able to be diminished before they occur. Listen to the member. Have they been talking about not having a job? Are they losing their job? Did their spouse lose their job? What is going on with that member? Again, teach the front line to be detectives of 3 important loan L's. Learn, look, and listen. Learn the importance of watching members' accounts and their payment habits. See if the member has a cell phone and an email address. Look at the account for any negativity. NSFs, or late payments, and listen to your members for any information that they might reveal of any current problems they might be making in their payments. If the credit union is doing real estate loans that allows them to draw from their line of credit, when members request to draw, reevaluate the value of the collateral. If it has been declined considerably, consider lowering the credit line on that property. Delinquencies should be worked continually and should start at 15 days to start the communication process. Try all avenues in contacting the members through correspondence, their home phone, work, cell phone, and now even through email. We have found that even text messaging, and if you have a cell phone, text messaging the member if they're delinquent is working. They might even text you back and tell you when they're going to come in. We're finding that to be very valuable, and the email also. Try to get the member to work with you. When the member loses their job and can't pay the loan payment, the credit union needs to consider options that would help you and them. Options to consider: interest only until back to work, lower payments for a short time, maybe 3 months, and then maybe renew one more time if needed. This will lengthen the payback period, though, but you will still be working with them and helping them. When the member won't work with you, work the account as soon as possible. Take back the security in a timely manner. Evaluate the value of the collateral, since the value might be significantly lower than the loan balance. Sell the vehicle and rewrite the difference if the member is willing to still pay you back for the difference. When delinquencies start to increase, the credit union may need to redirect some of your staff to lending to collections. So if you have some loan officers, it's good to get the loan officers involved in collections, because then they see what people that they've given those loans to now are delinquent. What did they might not have seen when they gave that loan? So again, the important lesson here is same as the new loan risk, know your borrowers. Now we're going to go on to some credit union risk. Member growth is possible too when you continue to do what you do best. Treat members as you would want to be treated. People helping people. I can remember back to 20-some odd years ago when somebody told me that's what we were doing, is people helping people. And now in today's economic times, I see that more and more and more. And we have to teach our employees really what that means. They're not used to that if they haven't been in credit unions for a long time. And they need to know that we have to build our credit union on loyalty. Loyal members will recommend the credit union to family and friends. And from that, we will grow. During these economic times and in the prospering times, credit union risk is always an issue to be examined. If you do not have growth, it's important to watch different things when it comes to credit union risk. Current budget examine monthly for variances. If you see that you're having variances continually and during certain budgets, maybe you need to revise that budget so that you know why those things are such large variances. Anything over $400 variances on our budget, we take to our board of directors and explain to them why we had such a large variance for that month. Look at all the expenses that credit unions might want to do without. Usually the first expense is travel and conferences, even though this might be important because of learning and to get some other ideas. Look at sending less people. Use more avenues such as webinars instead of in person, just like this webinar that we're doing for you today. Tighten expenses, but don't overcut the areas that might be detrimental to the credit union. Look at restructuring fee income to increase income to help cover some of your expenses. Make better use of existing people, processes, and technology. Identify the risks on the balance sheet. Use ratios to evaluate the total financial performance of your credit union. Keep doing the best that you can to make your credit union what it is and what keeps members coming back to you. Challenges will always be in front of you to conquer from time to time. That is the process of risk. And as I say every day is a day for learning and helping others. And that's what I think we try to learn every day, is that if there's somebody else that we can help, we've done what we do in credit unions, and that is helping people every day. So I commend you for being in credit unions, and I hope that you continue to prosper and want to work in credit unions. So I think now we're going to go on to the questions and answers.
Yes, at this point in time, I would like to have Josh kind of take over, and Josh is going to be facilitating the question and answers. Josh, I will give it on to you.
Okay, we have our first question.
Hello.
Hello.
Hi, good afternoon.
Good afternoon.
I have two questions. My first question, is the evaluation of the institution you're investing in done in-house or by an external agency? Right? And the second question, how possible is diversification if credit unions are limited by law in what they can invest in? Those are my two questions.
All right. As far you're asking of evaluation of the institution that you are looking to invest in, it is a good idea to get a copy of their financial statements so that you can kind of do an analysis of their records. Now, I will tell you, like in the United States, any credit union can go to the National Credit Union Administration's website and pull up any credit union's call report information, and it has all kinds of information out there, historical information, so you can see how this financial institution has been growing. We can do the same thing here by going through the other regulator for the banking institutions, and you can pull the same sort of history there. So what you want to do is, it's very possible that you have your banks having to submit, ours have to do it on a quarterly basis. Maybe your financial institutions only have to do it, say, semi-annually or annually. But you should be able to go somewhere and pull down financial statements for the last couple of years and take a look at how this financial institution is progressing or digressing. Colleen, do you?
I agree with Mary Lee. We here have to pull, when we invest in outside of our first core corporate, we have to get financials and an evaluation of the broker that we use or the investor for us, or their financials if we're investing at an outside bank. So again, that information should be public, and it should be able to get by you at that institution.
Let me say that here in the U.S., the regulators tell the credit unions what they can invest in. Most of our credit unions do not get into, say, buying stock in, let me use General Motors, which is bankrupt right now. Credit unions are not allowed to do that type of investing. It is not in the credit union's bylaws on what they can invest in. It is set by the regulators. Now, most credit unions do have an investment policy that the board has set out what this credit union will invest in. So therefore, as I said earlier, small credit unions primarily invest in their corporate credit union and in certificates of deposit. Then you've got the law of some of your larger credit unions that may invest in, say, some mutual funds because they are a little more familiar with it. We have some credit unions that have bought into some of these mortgage-backed securities, which is part of the problem right now because these securities cannot be sold. Therefore, they're having to write those down. But if they're going to be investing in that type of an investment, they must have on staff or on the board someone who really understands the type of investment that they're getting into, what the risks are now and in the future. So it's not in the bylaws of the credit union. It is by a regulator and then by policies that that board has determined.
Okay, thanks, Mary Lee.
One question. What are the signs in a company's financial statement that would indicate their solvency, or you could use to assess their investment risk?
I'll be very honest. Because of the fact that I have been with the league and not in a credit union, I am not really looking. I think in order to look at signs of the financial stability based on financial statements, you can't look at just one set of financial statements. Just as your credit union, yes, you review every month your financials, but you also have a history, and you know we're going up, we're going down, delinquencies are up, delinquencies are down. You have to take a look at a number of financial statements, not just one single financial statement. You're going to have to look at what kind of loans does this financial institution give. Are all of their lending done in commercial lending, or have they got a split between commercial lending, say real estate lending, consumer lending? Take a look at where their excess funds are. Where are they investing? And these are the things you're looking at. And, of course, you're looking at their bottom line. How much of their income is coming from other sources? How much of it is coming from the various loans? So what is their yield on their loans? What are their yields on their investments? You may want to take a look at some of their expense areas. Compensation is a good one. Again, I'm not certain what you have in Antigua, but I can tell you that banks, are a taxable entity. Therefore, they've got to have completed tax forms. There has to be a way to be able to go out and pull some of that information that you can kind of verify what they're showing on their financials to what they reported to the taxable entity.
You have another question or a follow-up?
I didn't quite understand dollar cost averaging. Could you please go over that for me, please?
Okay. Mary Lee?
The dollar cost averaging. Okay. What that is making investing a fixed dollar amount. It's almost like your regular members that you're talking to and promoting to your members, that they should be making regular deposits into their savings account, okay? What this is maybe there is what we here call a money market account. What it is a separate savings account that maybe you're putting an exact same dollar amount in every single month and building up your portfolio that way. Money market accounts is, or mutual funds is another type of investment that you would deposit a certain amount of money every single month. Now, when you buy into a mutual fund, whatever the cost is as of that day is what you're going to have invested in it. So daily, that figure could change. And what it's doing is, what it's saying is you can slowly, regularly add money to whatever this investment you're looking at.
Okay. It looks like we are out of questions. Thank you much again for your attendance.